Hello, and a warm welcome to this ICAS On Demand webinar. I'm Chris Campbell, Head of Tax for Tax Practice and Owner Managed Business Taxes at ICAS, and I'm pleased to be hosting this webinar. For those unincorporated businesses which do not have a 31st March or 5th April accounting year end, basis period reform will impact on how their income will be assessed for tax purposes in the coming years. Despite the delay in the mandation for Making Tax Digital for Income Tax Self-Assessment, or MTD-ITSA, the implementation of basis period reform will continue as planned for the 2023-24 transitional year. And at ICAS, we are now focused on supporting our members with the implementation of basis period reform for their clients. To help explain and help us understand how basis period reform could impact you and your clients, I'm delighted to be joined by Tom Brown, a Senior Policy Advisor in HMRC's Small Business and Trading Policy team. Tom has led the development of basis period reform within HMRC from the outset and works closely with ICAS and other key stakeholders on its implementation. Before working in tax policy, Tom previously worked as a tax specialist at HMRC's large business directorate. And it's great to be hosting Tom, and I'm really pleased to be welcoming him to our webinar today. So without further ado, Tom, brilliant to have you with us today. Over to you. Thank you very much.
Excellent. Thanks for having me, Chris. And hi, everyone. As Chris said, I'm Tom Brown, and I'm going to talk through basis period reform for you today. So I suppose just to start off with a bit of background, the old kind of current year basis was introduced in the mid-1990s when we brought in self-assessment for income tax. And these rules broadly attempt to tax a business's profits over the period of account that end in the tax year. So they're very much centered around a business drawing up accounts every year and trying to tax the profits that arise in those accounts every year. Unfortunately, those basis period rules, the current year basis, can be very complex and confusing, especially for small businesses, especially for those without a tax agent, and particularly in the first 3 years of trade, where there's quite a few different sets of rules for different circumstances in the first and second years of trading. Additionally, things like overlap profits and overlap relief, where a business has a period of time, a bit of profit that's taxed in multiple basis periods, is a really poorly understood area of tax and a really complicated one as well, with most businesses that are eligible for overlap relief never actually claiming it, leaving quite a bit of relief that goes unclaimed and quite a lot of profit that gets doubly taxed. So to move away from this current year basis and to try and simplify the system further, we're going to introduce the tax year basis for self-employed businesses from 2024-25. Now, this tax year basis will tax a business on the profits arising in the tax year itself. So from the 6th of April every year to the 5th of April the next year. Now, most businesses are already actually on the tax year basis. So 93% of self-employed businesses and 68% of partners will actually see no change in how they report their profits because they're already drawing up their accounts to the 5th of April every year or the 31st of March. The remainder of businesses with non-tax year aligned accounts, so these might be businesses that draw up accounts to 31st of December, 30th of April, or sometime in between, may have to then apportion figures from more than one set of accounts to find the taxable profit for the tax year in the future. The apportionment is one of taxable profit, so that's the kind of final position after things like disallowed expenses from each set of accounts, and it's made by reference to days as standard, but alternative methods of time apportionment can be used if they're reasonably and consistently applied. So I think, for example, in HMRC's guidance in the Business Income Manual, we give examples of business apportioning by months or by weeks. So rather than trying to do a kind of complicated apportionment over 365 days, it may be reasonable for a business to do an apportionment over, say, 12 months, 3 out of 12 months instead. Now, apportionment is something that we're hoping will be a fairly straightforward process every year for businesses, though some businesses may find it easier to change their accounting date to move to using the tax year as their accounting date so that they avoid having to do an apportionment every year in the future. As part of basis period reform, we have brought in a set of rules that make the 31st of March and the 5th of April broadly kind of equivalent in tax law. So for trading income and also importantly for property income, what we're doing is setting the 31st of March as equivalent to the tax year so that businesses who draw all their accounts up for 12 months to the 31st of March don't have to make kind of small apportionments of 5 days or so every year to find the profits arising in the tax year. So these late accounting date rules treat the profits that arise for these businesses between the 1st and the 5th of April each year as arising in the following year. So they essentially kind of get shifted across to the next tax year. And that means that those businesses don't have to make that apportionment. They can just take the profits from those 12 months to 31st of March and count that as profits to the tax year. So as I say, this is the only bit of basis period reform that also affects property businesses as well. So all property businesses will be able to use this late accounting date rule in the future if they have an accounting date of the 31st of March. Now, these rules will apply automatically. So every business with a 31st of March or 1st of April, 2nd of April accounting date will be able to use these late accounting date rules. But there is the option for a business to opt out of the late accounting date rules if it wants to. We're not sure that the kind of cases where a business might want to do this, but the option is there if a business doesn't want these rules applied automatically. If a business does choose to opt out of the late accounting date rules, then it will have to make that kind of 5-day apportionment every year to find the profits arising in the tax year. But once an election's made, it has effect for 5 years. So you make this opt-out election in the tax return, it has effect for that year and then the following 4 years. And it's kind of I suppose, a sticky election. You can't get out of it once you've made that election. So hopefully those late accounting date rules will help to avoid some of the kind of small apportionments that have to be made in the future. I suppose that's a kind of summary of the steady state in the future after 2024-25 when we're on the tax year basis on a kind of consistent basis. But to get to that tax year basis, we have to have a transition year. So before 2024-25, we need everyone to kind of get up to speed with the tax year basis, everyone to get to the same point, the same position, so that we can apply that tax year basis from 24-25 onwards. And that's why 23-24 is going to be a transition year. So in 2023-24, all basis periods will be aligned to the tax year by extending non-tax year basis periods to the end of the tax year. So this doesn't mean that businesses have to change their accounting date at all. They can keep their accounting date as it is at the moment. But as I said before, some businesses might find it easier to align with the tax year going forwards. In 2023-24, all of the old basis period rules, apart from businesses that are ceasing, are removed, and all businesses, apart from businesses that are ceasing again, have their basis period determined by these new special rules. So the basis period in 2023-24 will run from the day after the end of the basis period for 22-23, and then it will run until the 5th of April 2024. So it will always capture that period between the end of the last basis period and 5th of April 24 to make sure everyone's on that kind of same starting point for the tax year basis and to catch everyone up to the tax year. Now, this basis period will consist of up to 3 separate components. The first part is the standard part, as we call it, which is the first 12 months of the basis period. The second part is the transition part, which runs from the end of that standard part, so that after the first 12 months of the basis period, all the way up to either the 5th of April 24 or a late accounting date, so for example, 31st of March. And then the third part, which may exist, may not exist, depending on your accounting date, is the very concisely named days following a late accounting date, which is the period after that late accounting date on 31st of March, for example, up until 4th of April, up until 5th of April, sorry. So the basis period itself may be extended to cover a longer period of time than usual. It could run up to, say, 23 months long. but it is broken down into these three parts, and these three parts are really important for calculating the effects of the transition on the business and for working out which bits of profit are normal, kind of standard profit, and which bits of profit are transition profit, which has special rules applied to it. So I think we'll run through a couple of examples now of different businesses in different transition years. So for example, in this one, a business draws up its accounts to the 31st of March every year. In 22-23, their basis period, use the standard rule, ran from 1st of April 22 to 31st of March 23. So the basis period for 23-24 will be made up of a standard part, which is the first 12 months, 1st of April 23 to 31st of March 24, and then days following the late accounting date, 1st of April to 5th of April 24. So in this case, what we'll see is the standard part will be charged to tax in 23-24. That'll be kind of standard profit. And then there won't be any transition part. There's no transition profit. And the days following the late accounting date, the profit is then shifted into 24-25 under the late accounting date rules. So in this case, the business is drawing up its accounts to 31st of March each year. It's drawn up its accounts in 22-23 to the 31st of March. Therefore, it's not really affected by basis period reform. There's no transition part, there's no special rules. It just kind of carries on as usual. And the same will apply to businesses with a 5th of April accounting date. They just won't have the days following the late accounting date bit. So then if we go on to a different business, a business that draws its accounts up to 31st of December each year. So in 22-23, their basis period ran from the 1st of January 2022 to the 31st of December 2022. Now their basis period for 23-24 will be made up of a standard part, which again is that first 12 months, so the 1st of January to the 31st of December 23. That would be their kind of normal basis period in 23-24 in the absence of any transition rules. But then because we've got these transition rules, there's that extra bit to the basis period, the extra transition part, which runs from the 1st of January 24 to the 5th of April 24. So what that is doing is it's kind of extending the basis period, dragging it out to last until the 5th of April so that it brings us all up to the same point to start the new tax year basis on. So there we've got a kind of, I suppose, a split between the standard part and the transition part. And a business then would have to apportion the profits that it made. If it drew up a long set of accounts, for example, apportion the profits it made between the standard part and the transition part to find out the kind of the profits arising in each. So an important part about basis period reform and an important part about the transition year is overlap relief. So what we do with overlap relief and how we kind of give overlap relief in 23-24. So overlap relief was a fairly big part of the old basis period rules for businesses that didn't have a tax year accounting date. So didn't have accounts to 31st of March or 5th of April, because all businesses with non-tax year aligned accounts will have experienced overlapping basis periods at some point in their history. It's a kind of feature of the old rules that businesses with non-tax year accounts will always kind of have that overlap at some point, whether it was on a previous change of accounting date or in the first 3 years of trade, there will be that overlap there. Now, if they were making no profits at that point, then obviously there's no overlap profits. But if they were making a profit during that overlapping basis period, then they will have been taxed twice on those profits and generated a corresponding amount of overlap relief. So if you were taxed twice on £1,000 worth of profit in the second year that you were trading, then you will have £1,000 worth of overlap relief stored up, ready to use in 23-24. So because we're getting rid of all of the basis period rules in 23-24, we're transitioning away from them. We are allowing all businesses to use all of the overlap relief that they've got in 23-24 as a deduction against trading profits, to either reduce those profits or to create or increase a loss. So all overlap relief in 23-24 is being allowed, but after 23-24, there will be no mechanism for a business to use any of its overlap relief. There won't be a kind of legislative route to get that overlap relief, and there won't be kind of any other routes to get the overlap relief, for example, as they would normally do on cessation. So it's really important that businesses deduct the right amount of overlap relief in 23-24, and that you have the kind of records and figures ready to be able to deduct the right amount of overlap relief there. So the overlap relief can either be overlap relief that would have been deducted if the business were to stop trading in 23-24. So, for example, normal basis period cessation rules, you would calculate the amount of overlap relief that you had left. Maybe you used some in the past, and you deduct that against your trading profits in 23-24. So that's the kind of, I suppose, standard route for businesses with a non-tax year accounting date. But then we've also introduced this extra route to get overlap relief, which is overlap relief that should have been deducted on a previous change of accounting date, but that the business didn't deduct for whatever reason. Maybe it forgot to deduct the overlap relief, maybe it didn't understand the rules at the time. But we're allowing businesses, if they're still running and they previously changed their accounting date, to deduct overlap relief that they should have done at that point in time. That means that overlap relief deductions might be open to businesses with a tax year accounting date. So it's worthwhile kind of checking whether there's been an accounting date change in the past to see whether you've properly deducted your overlap relief at that point in the past. It doesn't mean that a business can kind of choose one or the other of these deductions. If, for example, a business changed its accounting date in the past, forgot to deduct the overlap relief at the time, but still has a non-tax year accounting date, there might be some overlap relief that you can get back through the kind of the normal route, and some overlap relief that you can get back because it forgot to deduct it in the past. So there's a couple of ways you can get overlap relief, and we think it's really important that businesses are able to get as much overlap relief back as they can, because, as I say, after 23-24, I suppose that's kind of it for overlap relief. There's no way to get it back. So once you've got your transition part profit, and once you've deducted your overlap relief from that, we then come up with I suppose, a figure of transition profits. And that's a really important, I suppose, concept within basis period reform, this idea of an amount of transition profits that a business has, which it then can spread and is kind of charged a tax on as we go forwards from 23-24. So once a business has an amount of transition profit, that transition profit will by default be spread across 5 years, starting in the transition year. And then if a business stops trading at some point during that spreading, then all of the remaining transition profits are brought into charge in that year of cessation. So this kind of spreading mechanism for transition profits is intended to smooth the impact of basis period reform in 23-24, and to stop businesses facing a very large tax bill if they've got, for example, a 23-month basis period, so that they can kind of smooth that impact, spread the impact over 5 years, and kind of pay the tax bill, I suppose, over time. And a special calculation process applies to those transition profits to minimize their impact on the kind of definition of net income for certain benefits and allowances. So most of that kind of calculation process will be done on the HMRC side. Once you've filled in your tax return or your business's tax return for 23-24, HMRC will calculate the amount of net income and run the special calculation that we do on transition profits to work out the tax charge on it. But it's good to be aware for other purposes that there is that special calculation process in place that means that transition profits don't affect the kind of measure of net income that some benefits and some allowances might use. Now, we understand that some businesses might not want to spread the transition profits over 5 years. As I say, spreading applies by default, so every business would otherwise have that spreading applied to them for 5 years. So what we've done, we've brought in an election to accelerate transition profits so that they're kind of brought into charge sooner. So if your business puts in an election to accelerate in the tax return, it can bring in any extra amount above the kind of standard 20% spread, the standard 5-year spread, if it wants to, and it can choose any amount above that to bring into charge. So a business could, for example, kind of bring in an extra 10%, an extra 50%, or if the business wants to, it could just bring in the entirety of the remainder of the transition profits and kind of end spreading early, I suppose. So some businesses might want to do that in 23, 24. Some businesses might want to do that further down the line. Some businesses might want to accelerate depending on their circumstances, depending on other kind of claims and elections that they might be making at the time. But that option is there for businesses, and the effect of the election is then to spread any remaining transition profit equally across the remaining kind of spreading years. So any business that's in spreading, that has spread transition profits, will be doing so over 5 years, unless it elects to accelerate everything in a particular year, at which point kind of spreading ends. So just to run through a couple of examples of spreading and of transition profits. So if a business had profits from the transition part of £40,000, overlap relief of £10,000, then that means that they've got transition profits essentially of £30,000. There's a bit, I suppose, more of a involved calculation process for transition profits, and there's a statutory method of calculating it, but that's the effect, I suppose, of that calculation process. And then that is equally then spread across 5 years. So as you can see, £6,000 a year starting in 23-24. Then if a business elected to accelerate transition profits, so if a business has transition profits of £30,000 and they elect to accelerate an extra £3,000 worth of transition profits in 25-26, then as you can see, we've got £6,000, £6,000, and then in 25-26, £9,000 worth of transition profits brought into charge. Now that obviously brings an extra bit of transition profits into charge, which means that there's less to spread over the remaining years. So then that remainder, that £9,000 left, is spread equally across the remaining 2 years of spreading. So acceleration doesn't shorten the spreading period, and it doesn't continue the pattern of spreading, I suppose, in 23-24 and 24-25 on this slide. It instead spreads the remainder across the remaining years. So you then have a kind of equal spread, but you don't shorten the period. If the business, for example, in 25-26 elected to accelerate all of the remaining transition profits, then that would be where spreading ends, and there wouldn't be any kind of spread profits in 26-27 or 27-28. So going on to some other considerations and other thoughts around basis period, some things to be aware of. So losses during the transition part, we've talked about profits so far a lot in relation to the transition part. Losses in the transition part are just treated as normal. They're just treated as any other losses sustained during part of a basis period. They're just brought together with the standard part and then all brought together in consideration in 23-24. So there's no kind of spreading of losses. There's no special rules applied to those losses. They're just treated as kind of normal losses of the basis period. Now, also on the subject of losses, if losses are created or enhanced by overlap relief, then they are eligible for extended carryback. So there's extra rules to let people use those kind of losses created by overlap relief as much as possible, and they get extended carryback so that there's more years that you can kind of set those losses, use those losses to set against profits. That may occur where you have a particularly large amount of overlap relief, or it may occur where you just don't have any transition profits. But yes, losses created or enhanced by overlap relief are eligible for that kind of extra extended carryback. Importantly, as this is a question that comes up quite often, changes of accounting date in 23-24 and afterwards have absolutely no effect on the basis period in 23-24 or on the tax year basis in the future. So all of the restrictions that previously existed on change of accounting date, so for example, the 18-month rule, not changing your accounting date too frequently within a 5-year period, all of those restrictions have been removed for 23-24 and afterwards, and businesses can freely change their accounting date without it having an effect on their tax position or without being restricted to, say, an 18-month period of account. That means that in 23-24, you could change your accounting date to have a 23-month period of account if you wanted to. You could have 2 short sets of accounts. There's really kind of no restrictions going forwards on when businesses draw their accounts up to and how they draw those accounts up. Now, on the subject, I suppose, of partnerships, a question that we get asked quite frequently is how these kind of basis period reform rules apply to partnerships in particular. So partnerships themselves, I suppose, aren't affected by basis period reform because the partnership itself doesn't have a basis period. But the partners, so the individual partners who all have their individual profit shares, will all have individual basis periods, and they will all individually be affected by basis period reform. So if you are in a partnership, there are quite a few considerations to make around how the individual partners might be affected by basis period reform, how they all might have their own kind of overlap relief available to use, and how maybe some partners in the partnership who might be ceasing in 23-24, who might be starting in 23-24, might not be affected by basis period reform, where others who are continuing will be. So there are quite a few specific kind of considerations about partnerships to think about. One of the more kind of technical aspects of partnerships are the rules around partnerships with a trade and partnerships with other sources of untaxed income. So, for example, a partnership with untaxed investment income and also a trade. Now, these other sources of income follow the partnerships or the partner's basis period. So where those other sources of untaxed income would normally have a basis period that matches the partner's, and that partner is affected by basis period reform, then that source of untaxed income will also be affected by basis period reform, which could mean that those sources may have more than 12 months worth of profit brought into charge in 23-24. Now, just to clarify on that point as well, those sources of untaxed income don't have any of the transition profit rules applied to them or any of the spreading rules applied to them. So they are just treated, the extra income in that year for those sources of untaxed income is just treated as normal, and it's just all brought into charge in 23-24 as if it were a normal change of accounting date, for example. There are also other kinds of businesses with basis periods. So essentially those businesses with a trade that are charged to income tax, like non-resident companies charged to income tax, and some trusts and estates with a trade that are charged to income tax as well. So there may be some very, very niche cases where those types of businesses may be affected by basis period reform, even though they're not necessarily an unincorporated business or not necessarily kind of normal standard sole trader. And then as an extra point, payments on account, they will be affected by the tax paid on transition profits. So payments on account are based on the amount of tax that you pay in the previous tax year. The first payment that will be affected will be the balancing payment paid in January 2025, which covers the 23-24 tax year. And then payments on account will kind of increase over the spreading period to take into account the tax on the spread transition profits. But then the year after the spreading period, payments on account might remain higher than normal because they're based on that spreading period's tax bill. Now, I believe there is an option to submit a claim to reduce your payments on account because of circumstances where you reasonably think that that the payments on account should be reduced or you have a lower tax bill, and that may be something to consider after the spreading period ends, where you kind of, I suppose, you know that your business or your client's business will have a lower tax payment or tax bill at the end of the year, because of the end of spreading and of the end of the tax charge on transition profits. So that's something to consider, I suppose, when looking at payments from January 2025 onwards. And I think that is all of the topics that I was looking to cover today. So I will pass back across to Chris.
Thanks very much, Tom. That was a really interesting presentation and gave us all an overview of all things basis period reform. I just thought it'd be useful just to have a few questions that we've been asked by some of our members over the last few months, just as they're starting to think about the effect that basis period reform will have on them and more likely their clients. The first one is to do with capital allowances. Now, most unincorporated businesses will claim capital allowance on the various additions and plant, machinery, equipment, and so on that they have in their business. And how would you say that would affect the apportionment if you've got a business that's got a year end that's not the 5th of April.
Yeah, sure. So capital allowances are still, I suppose, basis period reform doesn't affect any of the rules for calculating capital allowances or the rules for capital allowances chargeable periods, I believe they're called. So all of the capital allowances calculations and claims will be made for a specific period of account, which is then apportioned as part of the tax year basis in the future. So all of your kind of deductions for capital allowances are made on a specific period of account. They're made for that period of account. You come to the taxable profit for that period of account, and then after that point you apportion it, and then you try and reach the profit for the tax year. So all of that capital allowances stuff kind of stays where it is at the moment, relevant to the period of account, rather than being affected by basis period reform, and rather than, for example, being moved to the tax year.
Thanks very much, Tom. And you rightly spoke about overlap profits and claiming that relief as part of the transition to the new tax year basis that'll apply going forward. Now, we've recently written about on our website about the new G form that HMRC has produced, so that information can be more readily available. Say, for example, if the previous accountant that acted for the client hadn't noted the overlap profits, and it was important that now, because it won't be possible to claim overlap relief in future, to have an accurate note of the form. Would I be right in saying that you'd encourage people to use the G form rather than general post in terms of getting that information if they haven't already got it for their client?
Yes, definitely. I think so. We've recently launched our overlap relief request G form on the gov.uk website, and that overlap relief request G form will allow you to submit as a business or on behalf of one of your clients requests for overlap relief information that we might hold in our records. So as long as there is a figure for overlap relief in one of the previous returns for the business, or if there are kind of historic profit figures that could be used to recalculate overlap relief, then we will be able to kind of play those figures back to you and tell you about those figures for the business that you're requesting, or the kind of the client that you're requesting for, so that then you can go on to use those in the 23-24 return. So I think we ask for a kind of set of information about the business, for example, name, business description, UTR, importantly, what kind of tax year it started to trade in, so that we can get a good idea of the business and we know where to look, essentially. And then we will take that request, and it goes into a specific queue to be worked on. And then we respond to you with the information on either the overlap relief that's stored in our records or the historic profit figures that are stored in our records that would let you calculate overlap relief again. So I would encourage agents and businesses to use that form. I think it's really important that businesses get the overlap relief that they're entitled to in 23-24, and that's why we've kind of launched this form, just to make it as easy as possible for people to send in those requests and get the figures that they need to fill in their 23-24 returns.
Thanks very much, Tom. And I certainly would also encourage anyone who's got clients who are affected by basis period reform to use the G form, especially if that's going to mean that they're likely to get the information more quickly, just as the run up to the self-assessment deadline gets that little bit nearer. You mentioned partnerships, Tom, and how some partnerships themselves don't have their basis periods. It's the partners who are in the partnership who will be more affected by the basis period reform. And we have had some members asking about if you've got a partnership with extensive rental income, how that would apply when basis period reform will obviously affect the trading income if the business doesn't have a 5th April year end or March year end.
Yes, yeah. So that would be, I suppose, the rental income, the property income, may be a source of untaxed income for the partnership. So if it does have a trade, then that source of untaxed income would normally follow the basis period for the trade. And so when basis period reform, when the transition happens in 23-24, the transition will also apply to that property income, will also apply to that untaxed income. So you'll get that acceleration, those extra months in 23-24 on the trade, and you'll also get those extra months brought into tax for the property income as well. The important distinction there is that the trading income gets the benefit of the transition profit rules or the spreading, but the other sources of untaxed income don't get those extra rules, and all of the kind of extra profit is brought in as if it were just normal profit, as if it was a normal change of accounting date. So those sources, again, those sources might have overlap relief that you can use against them. And there are special rules around, for example, if you have too much overlap relief in one untaxed income source and not enough in another, just to make sure that you do get the benefit of that overlap relief. But yeah, it's an important, again, another important case of trying to get the overlap relief figures, and another important case of trying to make sure that there is I suppose an understanding of the different income sources, different income streams that the partner might have, and how they're affected by basis period reform kind of individually.
Thanks very much, Tom. You mentioned payments on account, and we have had some members asking us about how payments on account will work in terms of managing their clients' expectations on their cash flows for their tax bills over the coming years. And how does that work in the context of the extra profits to be brought in, whether the spreading happens or not?
Yeah, so if so the payments on account, as I say, are based on the amount of tax paid by the individual in the previous year. So as the tax charge on transition profits is brought into that amount of tax paid that payments on account are calculated kind of based on, then the payments on account will increase once the transition profits have been brought into charge for the first time. So from January 2025 onwards, the payments on account should increase to reflect those transition profits. As I say, that will last throughout the spreading period, and then it will kind of linger on for a year after the end of the spreading period, even though there won't be that kind of tax charge at the end of the year then. So as I say, there is that option to put in a claim to reduce payments on account that some businesses might be able to benefit from. But yes, the tax charge on transition profits does affect payments on account, and so it will kind of have an impact on businesses during that period.
Thanks very much, Tom. And I'm just thinking as well that for taxable income, it's not just for the purposes of calculating tax, but there might be some other purposes, such as if the taxpayer had a son or daughter at university, perhaps they would have to apply to the relevant student awards body, depending on whereabouts in the UK that they stay. Have you had discussion with those authorities about how basic period reform would affect that assessment?
Yes, yeah, we have. So we've been discussing with the Department for Education, with the Student Loans Company, to properly identify whether, for example, transition profits would have an impact on the household income assessment. Transition profits will be taken into account in the household income assessment for student loans purposes. So we are currently working with the Student Loans Company to properly kind of to make sure that their forms and guidance is updated to reflect that, and to make sure that the right figures are brought across from the SA return in their household income assessment kind of process. But as I say, we've applied this kind of special calculation method on transition profits for 23, 24 and beyond. That means that for some benefits and allowances, transition profits won't be taken into account, but for others it might be taken into account. It just depends on how exactly that kind of benefit or allowance defines income, whether it considers total income or whether it considers net income. And so we've tried to minimize the impact by using that special calculation method. We've tried to minimize the complexity by HMRC doing that special calculation for you. But in some cases, it may transition profits may have an impact on other kind of benefits or allowances.
Thanks very much, Tom. And I'm just thinking as well that some of our members will act for clients in the agricultural sector who might be claiming the farmers averaging. I suppose there'd be other clients who might be in the creative arts as well, who would also use the different averaging scheme that's in place for that. How does the basis period reform interact with the averaging profits that business would have?
So the transition profits, I believe, are disregarded for the purposes of averaging. So there's a specific provision in the transition profits legislation, which means that they're not taken into account for the purposes of averaging calculations. So hopefully that should mean, similar to the kind of special calculation method, that transition profits don't have an impact really on whether whether somebody can or whether someone chooses to use averaging.
Thank you very much, Tom. And I think you've survived quite a grilling from me in the question front. So I think it's right that you get a little bit of respite. So thank you for that. And hopefully our members who are watching this webinar will find those responses as useful as I done. So yeah, so thank you once again, Tom, for such a comprehensive coverage of the changes that our members need to be thinking about when discussing basis period reform with clients who might be affected by it. Please remember that you can keep up to date with all the latest tax and other professional news, including latest information, guides and resources on icas.com. You can access technical support, whether on basis period reform or on other items, through the ICAS technical help desk available through the Contact Us section of our website. Now, this covers audit, accounting, tax, practice support, AML and ethics. It only leaves me to once again thank Tom and of course you, the viewer, for watching this ICAS webinar. I hope that it's been very helpful to you. So until next time, it's goodbye.